In this discussion, we will discuss the discussion question of list and explain the primary tools for financial statement analysis. If we see a discussion question like this or an essay question like this, if time allows, our goal is typically to expand on the discussion question or essay question, that being more likely for us to touch on the topics that are being looked for within an essay question and be able to contribute more information, new information to a discussion in the case of a discussion question. Keeping that in mind, let's go through this one more time. List and explain primary tools for financial statement analysis. So one way we can kind of think about this, one way we can add more information is typically to take a step back. We can say, what are we looking for? What are the key terms here? Then take a step back and say, what is this used for? Who would be using this information? And we can start going into detail on discussions such as that. So this is going to be financial statement analysis, tools for financial statement analysis. We could take a step back and say, well, why do we do financial statement analysis? What is financial statement analysis? Who would be using financial statement analysis? So obviously the financial statement analysis could be used by both internal and external users. In other words, it could be used by management internally. It could be used by external users such as creditors or investors or other types of external users. The external users are typically taking that financial data from financial accounting, the financial statements basically, and making ratio analysis on it to make decisions about whether or not to do business with the company in some way, shape, or form. When we're talking about the internal use, managers looking at the ratio analysis to determine whether or not they're doing well in particular areas, and that will help them to make internal type of decisions for the company in the future. So that's one thing we can take a look at. Then we have the tools for the financial statement analysis, and that's going to be our primary goal here. What are we going to use in order to do the financial statement analysis? For most people, the first thing that should kind of come to mind when you think of financial statement analysis is a bunch of equations or a bunch of ratios. So you could typically think of ratio analysis as our primary tool. And that's going to be a primary tool not just with financial accounting. Notice the primary tool with a lot of different measures. I mean, if you're measuring performance in just about any job, you'll pretty much have to use some kind of ratio analysis. And the jobs that we're pretty good at analyzing all the time, we analyze all the time different jobs, is sports players' jobs. We love analyzing sports players' jobs, but analyzing any other job is pretty much the same. We take we take all the data, what have they been doing, and we do a bunch of ratios on it, and then we compare it with other people. That's what we do. If you're a teacher, if you're a construction worker, same type of ratio analysis. Financial statement, how's the company doing? Same type of analysis. So we'll have a bunch of ratios, ratio analysis. Other two formats that we'll use, the main tool that we'll take a look at, which does include ratio analysis, but are also often broken out into their own categories: horizontal analysis, vertical analysis. So let's go through those. We're going to horizontal analysis is one of the tools, one of the primary tools we have. Horizontal analysis will typically be used for analysis of year over year or period over period, multiple periods in a horizontal fashion of the same company. So we might have year one and year two, year one being the base year two being the second year, the most current year, and then we would compare year over year. We could go through then the calculations of how this would happen. We would say, okay, here's the current year number in every kind of account, every account on the balance sheet and income statement. Current year, say cash, minus the prior year, say cash. There's the difference in dollar amount in cash. That would be the most intuitive thing that we would do if we were trying to analyze financial statements. Let's line them up. Here's the current year, here's the prior year. Let's subtract the two. There's the difference. There's the change in cash. It either went up or down from the prior year to the current year. That's great. Next thing we're going to do is say, well, what if I want to see this and compare it to what happened to another company of a different size? Just like we would say, what if I want to compare a baseball player hitting average, number of hits going up, but compared to another player that has a different number of hits, we'd have to say, okay, well, let's make it into a ratio. We can take the change and we can divide it by the prior year, and then we can have a percentage increase or a decrease, something that can then be used to compare. Now that is a ratio, of course, but notice it's part of our horizontal analysis because we're going to do that same kind of process all the way down through the entire balance sheet and the entire income statement, thereby being able to see each account in terms of a dollar change and in terms of the ratio change or the percentage change, percentage increase and decreasing. Those percentage increases and decreases then being something that we can compare to the performance of other companies that don't necessarily have the same dollar amounts as we do, or in the same range, and therefore the dollar change isn't very useful to us, but ratios can be. Vertical analysis, similar but different. We're going to do it to the entire financial statement, but this time not comparing year over year, instead comparing everything within the same year. Could be called common size financial statements oftentimes, same kind of goal. We want to put everything from a dollar amount to a percentage amount. If we make it a percentage amount, we can then compare it to other companies of different dollar amounts to see relative activity. If, for example, if we take a look at the balance sheet, we're going to compare everything on the balance sheet, all assets on the balance sheet, to total assets. So we'll say how much is cash divided by total assets? How much is accounts receivable divided by total assets? How much is inventory divided by total assets? And therefore, we'll get, instead of a dollar amount number for cash, we'll get a percentage of total assets, like a pie chart of total assets. And that way we can look at other companies and say, well, this company's bigger or smaller than we are, but they have a similar percentage breakout of their assets versus total assets. And we can compare that then to ourselves and other types of company, the ratio type of analysis. On the liabilities and equity, we'll compare all the liabilities and equity accounts to total liabilities and equity, which is equivalent to total assets, because assets equal liabilities plus equity. So we'll compare, say, accounts payable to total liabilities and equity. The division problem. We'll compare long-term loans payable, let's say, to total liabilities and equity. We'll compare retained earnings to total liabilities and equity. And we'll get the same kind of comparison in terms of thinking about what types of liabilities and equity, how much of a percentage of that is it of total liabilities and equity. We'll do the same for the income statement, but it's a little bit trickier for the income statement because the total that we're going to be going to is the top line, revenue, or sales, because we know that sales minus all the expenses is net income. Another way to think about that is net income plus all the expenses equals the total of revenue. So we're thinking of revenue as kind of the total. If we compare everything to revenue, if we compare, say, cost of goods sold divided by revenue, then we get a percentage of revenue. If we compare, advertising expense to revenue, we get a percentage. Net income compared to revenue, we're going to get a percentage. And we'll do the same type of analysis on the income statement, and we can compare that common size income statement to other income statements of other companies that have different dollar amounts, and that'll allow us to do basically a comparison. We could say, oh, their cost of goods sold is in a similar range as our cost of goods sold is in terms of a percentage basis, even though their dollar amounts are totally out of whack, totally different, totally out of the range that ours are. So the next thing we can do is obviously the ratio analysis. And that's probably the one that comes into mind for most people. So the ratio analysis is different. We're used ratio with horizontal and vertical analysis, but the ratio analysis, we think we break it out differently oftentimes when discussing it, because basically we're talking about specific type of ratios that we're trying to pick up. And we're going to break out specific numbers on the balance sheet and income statement, compare them, divide them, ratios, division problem in some way to see what is there. And then you can go into the different types of ratio analysis in a discussion question like this. You can go to the liquidity. You can say there's 4 categories of ratio analysis typically. Liquidity and efficiency, measuring our ability to meet short-term obligations. Solvency, can we meet the long-term obligations? Profitability, how are we doing in terms of our performance, in terms of profitability? And market prospects, which could include things that will include market information, such as the market price, things that are not included in the company itself, but includes market opinion in the form of market price typically. And then if you wanted to keep going from there, you can actually list out the items that are in liquidity and these sections, and then go over each of those ratios and start to discuss them, give examples of them. For example, liquidity and efficiency includes the current ratio, the asset test ratio, the accounts receivable turnover ratio, the total asset turnover, the inventory turnover, days sales uncollected, days sales in inventory. You can go into each one of those. You can tell what the calculation is. You can then go into detail of what it means. You can give an example of what types of things might increase or decrease those ratios. You can go into the solvency ratio and say, yeah, that includes the debt ratio, the equity ratio, the debt to equity ratio, the time interest earned. You can look at examples of those. You can tell how it's calculated. We can go to the profitability and say, yeah, that includes the profit margin ratio, the return On total assets, the return on common stockholders' equity, discuss the calculations of them and some examples, what would make those things go in up and down. Then you could talk about market prospects ratios, including the price earnings ratio, the dividends yield ratio, same kind of thing. What is it? What are the calculations for it? And give some examples of it. What would make them go up? What would make them go down?